If you've ever wondered, can I buy a rental property with no money down? You are far from alone. Every real estate investor has asked the same question at one point or another. And in this video, we're going to give you 10 simple ways to buy a rental property with no money down. In return, take a few seconds and subscribe to Life of a Landlord because we are your #1 YouTube channel for all of your real estate investing and rental property needs. Don't forget to ring the bell so you don't miss out on our next videos. Now here are 10 ideas for how to buy a rental property with no money down, or at least less money down, because there's no free lunch in life, but you have several options to slim or even eliminate the down payment you need to buy your first rental property. Number 1, consider house hacking. House hacking is the easiest way to buy your first rental property, and in the bargain, you score free housing. The traditional house hacking concept is simple. You buy a small multifamily property, let's say a duplex, you move into one of the units and rent out the other. Your neighboring tenant's rent covers your mortgage and other housing costs for effectively free housing for you. And when you move out, you keep it as a traditional rental property and the cash flow only improves from there. So how does this help your down payment? Well, traditional lenders require far lower down payments on owner-occupied properties than investment properties. It's a simple risk calculation for them. Borrowers are far less likely to default on their home mortgage than a rental property loan. One popular low down payment loan program is the FHA loan, which allows a 3.5% down payment as long as your credit score is over 580. And let's be honest, if your credit score is under 580, you should probably work on paying down debts before buying a rental property. But FHA isn't the only option. There are also conventional mortgage programs out there that require even less money down, sometimes no money down at all. Number 2, the BUR Method. One traditional model which still requires cash up front, but you get it back in the long run, is the BRRRR method. The BUR strategy acronym stands for buy, rehab, rent, refinance, and repeat. It works like this. You buy a fixer-upper with a purchase rehab loan, which does involve a down payment, but you then renovate the distressed property, financing the upgrades with the purchase loan. When the renovations are finished, you refinance the property with a long-term loan and pull your original cash back out. It works because the new landlord loan is based on the new after repair value of the property, not what you initially paid for. So if you created sufficient equity, you can pull some cash out when you refinance to cover your initial down payment. Keep in mind that while beginners love the idea of 100% financing, the BUR method is actually better suited to more experienced investors given the higher risk that comes with higher leverage. So start with lower risk strategies if you're a beginner at real estate investing. Number 3, seller financing. Of course, no one says you have to go through a loan program at all. Sometimes sellers will finance the property for you, allowing you to negotiate any loan terms that you want, including the possibility of buying a rental property with no money down. This works especially well with property owners who have no mortgage or sellers who inherited the property and don't know what to do with it. Maybe the property needs repairs and the seller doesn't have the cash to make them. Often, they're happy to accept regular monthly payments for the property and take the income along with a quick settlement and not having to hassle with real estate agents and commissions. Not every seller is open to owner financing, but many of them are. It's worth exploring with them and can prove an effective way to buy your first rental property with no money down. Tell us in the comment section how you feel about this investment strategy, and don't forget to hit the like button if you are enjoying the video up to this point. Number 4, assume the seller's mortgage. Even if the seller isn't willing to directly finance the property, you still may be able to work out with them how to buy a rental property with no money down. You can offer to assume the seller's mortgage and make payments on their behalf. You step into their loan, leaving you with only the remaining difference to come up with. Just be careful about triggering the due on sale clause in the existing mortgage. Remember, when you buy a property with conventional financing, lenders often won't let you borrow the down payment. They want your skin in the game, but in this case, you're not borrowing a purchase mortgage, you're just assuming the existing one and paying the seller separately for any difference. That means you can pay them however you want. You could borrow money from friends and family, you can borrow from your credit cards or a personal loan, or work out a loan with the seller themselves. It really does not matter if you use this strategy. Number 5, negotiate a seller-held second mortgage. Say you find a lender willing to cover 80% of the purchase price on a landlord loan, but you don't have enough money to cover the 20% down payment. One place to borrow the money is the seller. Once again, not every lender will allow this, so before you negotiate tooth and nail with the seller to offer you a second mortgage, talk to your primary lender first. Many portfolio lenders like Vizio or Lending One, for example, do allow it. However, it's worth noting that FHA loans do not allow seller-held second mortgages. Number 6, collateral-based lenders. Conventional and FHA lenders are sticklers for rules and regulations. They may not let you borrow money from the seller or from anyone else for that matter to let you buy a rental property with no money down. But not every lender is so fussy about where your down payment comes from. Landlord lenders and hard money lenders typically lend based on the property itself, the collateral, rather than on you as the borrower. The good news is they usually don't care where your down payment comes from as long as it's not from them. The bad news, they'll lend at a lower LTV, which is loan to value ratio, which means they require a larger down payment. So plan on coming up with a down payment of at least 20% for a long-term landlord mortgage and at least 25% for a hard money loan. By using a landlord lender or other collateral-based lenders, you can borrow the down payment from elsewhere, friends, family, credit cards, personal loans, or wherever it is that you want. One other advantage to using a landlord loan or other collateral-based lenders, they don't charge mortgage insurance or PMI for conventional loans. That means that even if the interest rate is higher, your monthly payment could still be lower since you don't have to flush money into mortgage insurance. Some investors take out a personal loan to cover the down payment several months in advance, then borrow the purchase rehab or landlord loan from a private lender like Vizio, for example, whenever they find a good deal. The money for the down payment is already waiting and ready in their checking account. Number 7, private money. As you gain experience as a real estate investor and build a track record of success, the people around you will become more open to lending you money themselves. You can borrow private money loans from friends, family members, and other acquaintances that you meet and negotiate loan terms that fit both parties. For example, I lend money at 10% interest to a real estate investing couple who I know personally. They don't mind paying relatively high interest for 2 reasons. First, I didn't charge any points or fees or other closing costs at the beginning of the loan, which saved them thousands compared to a traditional loan or hard money loan. And second, I left the repayment date open-ended and structured the loan as interest only. So everyone you know is a potential private lender. You just need to establish trust and credibility with them. Do that and you'll never have trouble buying a rental property with no down payment again. Number 8. Partners. We've mentioned friends and family several times now as possible sources of money for your down payment, but who says lending you money is the only option? They may want to just partner with you on a real estate deal. Imagine the following scenario. You don't have any money for a down payment, but you bring real estate investing expertise. Your friend has money for the down payment, but no time to spend learning the ropes of buying rental properties. Match made in heaven. They provide the down payment, and you provide the knowledge and sweat. Chances are you know someone who's looking to diversify, invest some money in real estate. Who doesn't love passive income? And rental properties produce passive income better than just about any other investment that's out there. Number 9, credit cards. While we've spent an entire video walking through the pros and cons, the risk and rewards of using credit cards to buy rental properties, they're worth exploring briefly here too. In an ideal scenario, you draw on unsecured business credit cards during an initial 0% interest period. Using a business credit concierge service like Fund and Grow, for example, helps you open between $150,000 to $200,000 in credit lines and cards on average. And they even show you how to pull money out at a 2.5% fee instead of the typical 3 to 4% cash advance fee. On top of that, you get to make cash offers since you have the money available instantly. The funding is far more flexible than a mortgage, and often the cash advance fees are mitigated by the reward points. Now, as for the interest, the trick is to pay that balance down and fast. You're on a race against the clock at that point. How quickly can you pay off the credit card balance? If the answer is within a few months, let's say, it's a promising strategy for you. If the answer is within a few years, then maybe you want to think again again about this strategy, but at least you'll have rental income from your property to help you pay it down faster. And last but not least, number 10 is HELOCs and second mortgages on your residence. Another idea to buy a rental property with no money down is to borrow money from your current residence. Home equity lines of credit or HELOCs are especially useful for this. You secure a line of credit against your home equity and you draw on it as you need it and pay it back with rental income. You can even take out a HELOC on an investment property. For example, buying a rental property for $100,000, you can simply borrow a landlord loan for $80,000 using the equity built in your current residence, leaving you to come up with the other $20,000 to buy your $100,000 property. It's a lot cheaper to borrow money from a HELOC than it is from your credit cards, at least when comparing the interest rates. The upfront cost to pull out a HELOC will be higher since the lender will need to run a title history on your home and will almost certainly charge you junk fees. But still, HELOCs are the gift that keep on giving. You can keep rotating it through as you buy a rental property, pull the money out, pay it back, and then repeat the process all over again. So we hope you found this video valuable. If so, do us a favor and smash the like button below this video. Also subscribe to the channel and turn on post notifications so you don't miss our upcoming videos. We've also put together an entire playlist to help you get started in real estate investing, so check those videos out as well. Until next time, we'll see you guys in the next video.